Good morning, guys. Good morning to all of you. Thank you for tuning in to our consumer webinar for first half of 2022. And in this chat, I think there's quite a lot of you here right now. And some of my friends wanting to know about the property market. Welcome to see me working on a Saturday morning. And then some of you are your friends of my friends who are from NAVIS, right? Our NAVIS Realtors friends and clients. Welcome. It's a pleasure to host you all this morning. Thank you for joining me, and a happy new year to all of you. Okay, have a blessed new year, a wonderful year ahead, and 2022 will be a greater year than 2021, I'm sure, right? Okay, so now we'll go into this property market direction talk right now. And before we go into the subject proper, we'll cover some of the past talks, these forecasters we had previously, to see where exactly are we on the accuracy of market prediction. Okay, analysts like myself and many others, we are regarded as sometimes wrong most of the time, right? Because analysts, make a lot of predictions, not entirely true all the time. Sometimes it really depends when the government wants to act and the black swan events that happen. And of course, some are plain wrong. Okay, so just let's take a look at what I've predicted in the past and what has come to pass. Now, sorry, before we go into that, I just want you to read a very interesting article. Investment disclaimer, everything in this talk is just an opinion. Please make your own judgment call. Please seek your own advice, legal advice, financial advice, agent's advice before you take action on anything being shared here, okay? Okay, so in January 2020, a year ago, that was when I had a prediction in one of our talks that there will be an en bloc market. Okay, there will be an en bloc market. The likely high en bloc market will be somewhere here. If you can see, I'm going to point out to you right now. The en bloc market will be right somewhere here from 2021 all the way up to 2023. As you can see, this part came true. So we could tell this was upcoming due to what reasons? Because of inventory being sold and the pace of inventory being sold. Okay, the pace of it being sold. Because of that, we predicted 2021 will be a high en bloc market, 2022 and 2023, this period. All right. So 2021 did indeed become a high en bloc market. So it did come true, as you can see in one of the articles by TBS. Okay, this is September 2021. However, of course, the government came in at the end of the year to kind of slow down the pace of the party, right? As we all know, because it became too fast. And you want to know why it's too fast? It's because the last quarter of Q4, everybody were really revving up their purchases. So just in the last quarter of 2021, guess how much it went up? Just make a guess. You just make a guess. If you want to put into the chat group, you can put in the chat group a percentage guess that the last quarter of 2021 that the property market went up by. All right, it's actually 5%. Wow, last quarter, really chong. Okay, so anyway, this part came through 2021. Indeed, it was a high en bloc market. Whether this year and next year will be as high, we do not know yet, because everybody's just waiting and seeing, and waiting for acceptance of the new price points, or whether the sellers will budge, en bloc sellers will budge. Okay, so this came true to a certain extent, not 100%, but a certain extent, because we don't know yet whether this year will come true. Now, in December 2020, during our consumer seminar, we mentioned about, are we on the cusp of a real estate bull run? So I shared with you a lot of points about why it is very likely that we are going to see a bull run coming up. Okay, that's a whole 1 year ago from now. And prior to this, even in the middle of COVID, I bought something because I was so bullish. I knew that it was coming back based on my studies of the global financial crisis, how money supply increased, how the Federal Reserve in the US reacted, how Singapore markets reacted, and that's why I put my money down. Okay, so I hope you did then, because what has happened since then, we all know. Okay, I shared with you about the forecasted market bull run in the market. That was December 2020, right? On how markets react when the US Federal Reserve prints money. Is like it rains on the mountain, and it comes down slowly into the valleys and the streams and the rivers towards the sea. So Singapore is far away, right? And because Singapore's property market is kind of another asset in another denomination in a faraway land. Okay, so it takes time to come towards us, this wave of money flow. So what has happened since then? Well, we predicted that after they print money, okay, US stock market rally, because based on past experience, this has happened. Singapore stock market rally, which happened, okay, and then likely 5 quarters later, we will see real estate market rally. Okay, so rally strongly. So it did come true, and not only that, towards the end of last year, second half, end of last year, it really rallied very strongly. Okay, so this was what has been shared before. I hope you attended those talks. I hope you took action, because if not, what a pity. Now, in early 21, I also told you that there was a probability of cooling measures. It was high. If you want to buy anything, you better buy soon. Why? Because it gets harder to get through. It's like the eye of a needle. You get smaller and smaller and smaller until you really can't squeeze through, right? It's very hard to buy as time passes. In the past, there's no EBSD, no SSD, no loan to valuation limits. It's a lot easier to buy for you to buy a second, third, fourth property. But these days, to buy a second one, a lot of people have to consider, because you need a lot of cash on hand, you need a higher income, and so forth. Okay, so well, early 2021, I gave you this warning in one of our talks. December 2021, okay, it came true. And well, I can tell you that the government is still monitoring what's going to happen in the next few quarters if things do not cool down sufficiently, because it's gone up so fast, too fast for their liking, right? They want a sustainable and steady property market. If it goes up too fast, you can bet that another cooling measure will come. Perhaps the TDSR will be lowered again. Perhaps the loan to valuation will be lowered further. Perhaps your your BSD might go up to 5% instead. So if you are still sitting on the fence, it just gets harder to buy. Yeah, so it might not be such a great idea. Huh? So I'll share with you why and how you can get in and select the right property later on. Okay, so this was what was implemented December 2021, right? For those of you who are clueless, what happened? Okay, I'll just quickly refresh you. Well, TDSR has been tightened from 60% to 55%, which makes it harder to buy. You need to earn a higher income in order to qualify for the same amount of loan. All right, your higher ABSD rates. Okay, so for Singaporeans, your second property used to be 12%. Now it's 17%, 5% more, 15% became 25% for third property. Okay, for PRs, your second property, right? First property, no change. Second property is increased by 10% from 15 to 25%. For third property, 15 to 30%. Okay, that's double. And then for foreigners coming in, from 20% ABSD to 30% ABSD. Very, very painful, right? But I'll show you later why it's not actually so painful for them. All right. Okay. So entities wise, any businesses buying residential property, which is quite a rarity these days compared to long ago, where a lot of people use BVI companies, shell companies to buy, right? These days, very few people use that way. But it has went up by 10%, from 25% to 35%. Okay. So these are mainly for your private properties. Okay, because private properties really went through a lot of growth in the past few years. Whereas you can see in the purple box, okay, the purple box number 3, loan to valuation for HDB granted loans only went down 5%, and only for HDB granted loans. So from 90 to 85%, which is really nothing much, to be frank. It's a very light touch on the risk. Just to I'm guessing, just to show the world that just to show Singaporeans that you see, we are targeting the whole market, not just private owners. Okay, so people feel a bit more comfortable that it's a market-wide measure. All right. So it is important for us to note. Okay, this is a chart by Huttons research by Zetic. Okay, it's important to note in the past when the first time cooling measures were implemented. Okay, first time, which year was that? Was 2013, right? 2013 when cooling measures were implemented, volume came down a lot. Okay, you can see over here, 2013. Okay, after the cooling measures were implemented, volume came down drastically from that amount. Okay, why? Because, well, people were, over here. Okay, people were very much afraid and unsure how TDSR, such a drastic measure, will correct the market. People were very unsure because, well, by then, right, ABSD was very costly. Loan to valuations were low. TDSR was a nail in the coffin. So everybody took a wait and see approach. And then subsequently, we had in 2018 an increase in ABSD, lowered LTV. Okay, but this time round, it was no longer new, right? TDSR, we came to live with it. The markets did come down, not by much, but about 11% over 5 years, and then bounced back. Why? Because Singaporeans' balance sheets, household income, household wealth started to go up again. So people could afford to buy. And because earnings caught up, household median incomes caught up. All right. So by this point, when there was another cooling measure, okay, well, the market reacted once again. Knee-jerk reaction. Everybody likes to wait and see, right? Passivity. In my blog, I write about passivity. People like to take no action because no action seems safe. Wow, but no action actually can be dangerous in investment because time is ticking, no matter what. So you can see that over here, it went down 1 quarter, 2 quarter, 3 quarter. By the 4th quarter, it bounced back up to the same high. Okay, beyond that, of course, we had COVID coming in. Lull at the end of the year is common, and then COVID coming in. So we discount this because this is definitely a period where people can't even be mobile enough to see houses. But otherwise, within 4 quarters, it bounced back because people were already used to it. Acceptance is there, right? Just like GST, we complain when it happens, then we also accept. Then after that, it becomes normal. Okay? We don't even think about it when we buy something. So general acceptance of cooling measures in 2018, it took 4 quarters to be, okay, let's go and buy again. Forget it, government is not going to remove it. And the market, most importantly, the market isn't really coming down. Why? Because there's no sell side pressure. There's no panic. Okay, by 2018, what we saw was there's no panic because why? The financial system is robust because of TDSR. New people are buying, a lot of people are buying and had a lot of good financing. Even in a market downturn, you don't have to worry that they were dumb because by and large, they have put down a lot of money. By and large, they have good incomes to support their loans. Now, for this time round, what we see is that volume should recover within the 2nd to 3rd quarter of 2022. So currently, we expect volume to still be affected because, as usual, everybody likes to wait and see, right? And that's the majority of the consensus and the herd instinct. So when that happens, and of course, with the media, what I call propaganda, whatever you read in the news, is there to either make you take more action or slow down your action or take no action, okay? So whenever government puts out a lot of articles about, wow, it went up so much, be careful, be cautious, guys, don't keep taking loans, be very wary. You know what the government is trying to tell you. Slow down, okay? But important, always to visit first principles. Is the government trying to crash the market, or is the government just trying to make sure nobody rushes? There's no panic buying, like buying toilet paper, right? Buying property like buying toilet paper. So they are just trying to make sure it's moderated. So for those who are savvy to cut through the noise and the, all the propaganda, you must know that government is trying to ensure a steady and sustainable upward move, not a downward move. Okay, why? Because a lot of our savings, a lot of our retirement funds are inside our property, right? Whether ourselves, our parents, the young generation, a lot of people's lifetime savings are inside. So there will be no way that government want to crash the market. Okay, but you have to just ride along with them and know what they are doing is to ensure steady growth, as long as incomes growth and can catch up, the young people can buy their first homes, it will be okay. Okay, so read between the lines. Don't just take the daily headlines and then make your decision based on that daily headline. That is very reactive and that is not the way to invest. Okay, so next. Now, this is what I like to illustrate how I like to illustrate the Singapore property market. It's like a tightrope walk. Okay, so the government is holding on to this this balancing bar, and there's the fund inflows coming in. These fund inflows are from where? Well, we know foreigners coming back into the market to buy because liquidity. These funds are cheap. Fund flow is always looking for quality assets, right? Okay. Then there are also global uncertainties that the government got to balance because something like COVID could throw us off totally and create a lot of unemployment. So they have to balance, all right? But there are a lot of market stabilizers already in place. So you have to know that you're investing in a quality asset in property. That's why I also put my money in it, right? As much as I can, okay? So there are a lot of market stabilizers in case of strong winds or just somehow someone rocks the boat, right? So there are stabilizers like TDSR, the ABSD, LTV limits, loan to valuation limits, GLS supply, okay, all these things and more, okay, developer side guidelines are there to ensure market is as steady as possible. Why? Because in investing, there's always risk. Risk and volatility, right? Volatility. So with stabilizers, you lower the volatility. Even in high winds, this particular rope doesn't swing so much. Okay, that's important to know. And even worst case scenario, even if let's say a very huge event topples the tightrope walker, which is the government holding on to all of us, right, our properties. Even if it falls, don't worry, there's a safety net. Okay, there is a safety net. You will never lose money 100% with properties. Why? In most properties, I caution most properties. Why? Because whatever the case, all these cooling measures, market stabilizers, when removed, right, if they need be such a bad event happens that they have to lower ABSD, increase the LTV limits, increase TDSR or suspend TDSR for a while. Okay, not right lightly, but I'm just saying. Okay, these will all heat up the market as we've seen in the past. In 2017 March, when they reduced SSD, straight away a lot of people came back to buy. A lot of developers came back to buy land. Okay, so we have to know that the risk is very low. Okay, so next. Now, I want you to think about this, okay? Because you might be thinking of buying a next property, you might be thinking of upgrading, you might be thinking of even, should I buy an EC or condo straight away instead of buying my BTO, right? Now, and then you're worried, what if this is the peak of the market? What if this is the top, I'm buying at the top? I'm silly, right? Okay, I want you to think for yourself, where are you at today? Crowd psychology, okay? Because this is where investors either come in, get out, or stay put, not moving much. So where are you at? Okay, do me a favor. I just want to see your responses. So you can put into the chat group. Okay, you can put into the chat group, which are you at today? Okay, which are you at today? Okay, please participate. Are you at despondency, the worst of worst, you capitulate totally, throw it, I give up, I'm not buying anything, I'm selling off all my property? I don't think so, right? Are you still depressed over what has happened? Are you hopeful now that we are at the end of our the worst and recovery is on the way? Are you at relief, or are you even at optimism? Okay. Now, I'd like to see some of the answers. If you can join me, put into the chat group. Okay, so I can read out some of the answers and let you know what other people are thinking. Okay, it's very important that you participate. Put in your answers. Okay, you know why? Because some of you are naturally biased towards negativity. You're always depressed. Some of you are always excited. Some of you are always optimistic. So if you are biased, you will find that you have blind spots because you're always depressed. You say, market went up, it's going to go down next month. It's going to go down next month. It's going to go down next month. And you are forever thinking like that through life and you never buy anything. And those of you who are optimistic, you may be forever optimistic. It's going to come up next month, and so forth. And it's also not good for you. Okay. So it's always important to know your blind spots. No, I'm naturally a cynic. I'm always bearish. But I know I need to back up my bearish bias or correct my bearish bias through looking at numbers so that I can be convicted what to do, and I can be also convicted that, okay, this is the right way. All right, that's why I'm so data heavy. I know some of you on Hardware Zone and all are saying I'm very data heavy. So be it. Okay. Now, Julie is hopeful. Good, you're in a hopeful stage. We have those in the optimism stage, panic stage. Wow, that's one of you still in panic stage. Panic stage. What is there to panic? Omicron, maybe? Okay, I'm not too sure. Some people are saying Omicron is actually the natural vaccine to COVID. Excitement, okay? Some of you are excited. Exploring. I'm sorry, there's no exploring on this cycle of emotions. You might want to try again, okay? Some of you are thrilled, okay? Thrilled is thrilled is almost the top of the market. Okay, low risk, low risk isn't one also. You can try again. Optimistic, okay? Suggest a pull in the future. Okay, I know. Yeah, thank you so much. Hope. Another one is in hope. Okay, so a lot of you are most of you so far, I see, scroll down, are in a hope, relief, optimism stage, because somehow you feel that we might be past the curve, the bottom of the curve. Yeah, we have a few more hopes and so on. Okay, thank you so much for responding. So it's important to know the general market. If you are in panic stage or still in depression state on the market, know that people around you might not be. People around you might be buying into the market, and like it or not, the majority of the crowd will change the market. Okay, the majority. This is just a sample size, of course, but we've got to see what the whole market is doing. Is the market, are they all in depression state, despondency state, panic mode, which happened right in a COVID period? that was the best time to negotiate and buy. But right now, a lot of them are relief in the hope stage. Okay, so a lot more people are comfortable taking some risk, putting their money down. And you might not be wanting to wait and wait and wait. Okay. Now, just to let you see an overview across major global asset prices is important also. I know some of you invest a lot in overseas China stocks, US stocks, and so forth. Some of you don't at all because you are more risk averse. You might also not like to have to monitor all this volatility in the investments. So, but it's important to know because when we compare property in Singapore, it's no longer something that just Singaporeans will buy to stay in. It is a global asset class. Singapore itself is an asset class. Okay, why? Because people like to hold the Singapore dollar. It strengthens year after year after year against most currencies. So we must know what are investors looking at when they finally want to invest. Where is cheap for quality assets? Okay, investors are always looking for cheap, good upside potential, quality assets. All right, and well, of course, there are some speculative assets, but we'll take a look at the major ones making the news. And then we will see whether they have gone up by so much that people might just be thinking of diversifying even. Okay, so let's get started. First, the STI, our Straits Times Index. This is the performance pre-COVID, somewhere in early February. It went down 32%. Okay, a very drastic drop, 32%. And then since then, it has gone up to minus 5% since pre-COVID. We take pre-COVID as an indicator. Why? Because pre-COVID, everything was smooth selling. Well, a lot of DBS, our Ministry of Trade and Industry, and various other banks and were all and government bodies were all very bullish about the economy until this Black Swan event struck us. Okay, so an investor who holds $1 million or let's say $500,000 in STI would have seen his wealth drop by 150K during that period. Some of them might have capitulated. They would have thrown in the towel and said, I give up, I can't see it anymore because it's very volatile. It can go down so much in a day. Some of them might even get margin calls and so on, and we cannot hold on to their stocks. Okay, we use STI by the way instead of individual stocks because there's 1,001 permutations, what you hold, what he holds, and so on. We can only use the benchmark. Okay, to be fair. S&P 500 for you who invest in the top 500 companies in the US. Okay, when it went down during the COVID incident, it was 36% from the peak, and then it ramped up all the way up to about 39% from pre-COVID times till now. If you take the bottom to the top, it's more than that. It's probably 60 plus to 70% growth by now. So it's gone up a lot. In the past 1 week, you have seen it correct because a lot of tapering were mentioned by the Federal Reserve. So investors get scared. And for some quarters of the market, they are saying that it's almost or at the peak already. Are you sure you want to buy into the S&P 500 at this point? Although the long-term returns is really very attractive, one of the best in the world. Okay, so this is how S&P has performed. Bitcoin, I know some of you, some of our teammates are also speculating in Bitcoins. I personally do not buy that. There's no underlying value, so I'm scared. I'm a chicken. So you can see here that it went up by 310% pre-COVID till now. I don't even put down the correction, it's negligible. Okay, it's gone up by 310%, but it's super volatile. Once it goes up, say 60 plus K, it can come down in the next few weeks to half the value. So not a lot of people have the risk appetite to take on such investments. Okay, so even if you put some money there, most of us will not put too much there. And then we take a look at gold performance. Gold this time around isn't the star player in a volatile market, not really so because there's a lot of alternatives like cryptocurrencies people turn to. So gold is kind of losing its luster. Okay, we went down 9% during COVID, all right, and then went back up till date, right? It's about 11.8% since pre-COVID till now. Not fantastic, honestly. There's a lot of instruments that outperform gold. And then let's take a look at our private residential properties since COVID. During COVID, it went down 14%. Okay, at the bottom of it, we got to see the bottom over here, 14. Okay, then since then, right? Okay, from the pre-COVID till now, okay, we can only take up to November because December's results are not all out yet by URA. So it went up by 15% since then. Okay, outperforming gold. It dropped 14%, but it did not drop a lot also. So it's not as volatile as you know. Real estate is not that volatile. So if you're risk averse, great instrument to go into. Okay, So you can look at that performance. Now, let's dive a little bit deeper into real estate in Singapore's different segments. Okay, so how has landed, HDB, and non-landed markets performed? Non-landed markets refer to what? Condos, apartments. Okay, so now we can see in the yellow line, okay, landed has gone up by 12.6% in the past 1 year. Non-landed condos, apartments have gone up by 9.6%. Okay, and then 12.5% HDB. They have gone up by 12.5%. Basically, all three markets have gone up very well. Obviously, very clear. People can't travel. They need more space from their parents, from their spouse to do their work, so forth, right? They get a place outside or they get a bigger place. They rent a place even, okay? So rentals are also doing very well, by the way. So in the past 1 year, if you are an owner of an average HDB flat, your 500,000 average price would have gone up to 62,500. 500,000 is the median price of HDBs these days. Okay, an average condo of 1.5 mil would have gone up by 144K. You have earned double what an HDB owner has earned. An average landed property owner, which is 3 mil, okay, has appreciated by 378K, which is a lot. So you can see that why they say the rich get richer, right? Because the asset class that you own goes up a lot, okay, a lot more than the other property type. A landed property owner sitting still on his property, of course, they have to have more cash to buy in the first place, but it goes up by easily the amount that you can feed a family of, a couple of families, 2 to 3 families even, right? You can feed 2 to 3 families with this amount of appreciation. Whereas condos, it went up by 144K, almost equivalent to the average household income of one family, okay? And HDB have gone up by 62,500, still respectable, still good, okay? Now, this is a bit on the global property prices since COVID. This is taken from UOB Private Bank because a lot of investors and even especially Singaporeans are thinking that, wow, our market has gone up so much. I can't dare to buy now because we are so expensive. Yes, if you are basing on the past, everything you know today is expensive. Taking a bus is more expensive. Buying kopi today is more expensive. Buying milk today is more expensive. Can you don't buy? Can you wait and say you go back to next time price? The last time price? The fact is we can't. We have to move forward from today, what's available, project the future. Is it going to go up some more or is it going to go down? Are we at the top of the market? And then we take action or not take action. Okay, but my fear is most of us like to live in the past, right? It's comfortable, it's where we have been before. And we all keep referring to the past, buying back at the last time price. But it's not really possible when globally asset prices have already gone up. And I've shown you different assets instruments. Now I'm showing you just global property prices. If you look around the world, right, and these are the major economies, okay, you can see that New Zealand has gone up a lot. Okay, the gray line. New Zealand has gone up a lot, 23% over here, the gray line. South Korea has gone up a lot, okay. China, Shanghai, Hong Kong, Beijing, Malaysia has gone up even more than us, okay, the blue line here, okay. Now, where is Singapore at? Okay, we can go down the line. It's Australia, the world average, Thailand. Singapore is here together with UK, okay. These are according to UOB Private Bank's research, okay, where property prices have gone for major countries. And Singapore has gone up by only, okay, at that point in time, when they did the research, 8.4. End of the year is almost about 10 already. Okay, so you can't buy a different country's property and want to stay in it, right? You have to buy here and stay here. And it's also easier to manage at the same time. Okay, but what I'm saying is, when something has gone up in price in Singapore, it does not mean it's expensive. You have to see relative to what's costing an investor in different instruments and different parts of the world. Okay, so Singapore as a whole, you take a macro picture, is not expensive. That is why government has resisted taking action until December. And because December was really too much growth at once, 5% in a quarter. Imagine that. Imagine every quarter grows 5%. It's like 20% in 1 year. That will be crazy. That will be like New Zealand, 23%. Okay. So that is why they had to take action in the last quarter. But relatively speaking, Singapore is still attractive. Okay, Singapore's property is still not overpriced. So let's say let's take a look at inflation versus property indices. Okay, so that you know too, the blue line refers to your consumer price index, a basket of goods and services in Singapore's economy. So you can see over the history of since year 2000 till now, if you had a landed property or a private or even an HDB, you would have outperformed. Okay, this index tracks the performance. Okay, the performance which performs at a higher return. Why? Because you want to outperform inflation, so that it's a hedge. Whatever you earn doesn't get smaller and smaller. Okay, so you can see over here, these three have outperformed inflation just from a point of view of hedging against rising costs of living, which is an eventuality. Okay, GST is also going to increase, you know that. So you have to buy into property. Okay, the more you buy into property, the more you're hedging your funds. If you do not, you're putting money into the into just your bank or your fixed D, you would suffer. In the long run, you will suffer. Even at worst, you are very risk averse, put it in your CPF or ASA. At least it can help you to hedge against inflation. Okay, the HDB resale index versus household income. Well, there is still growth prospects for HDB market. Okay, so if you're holding on to a HDB and you say that I just want to hold on a little while, I'm not ready to buy a private now because my income hasn't caught up, I haven't saved enough, that's okay. All right, just know that HDB resale prices are still slated to go up. Reason being, there's still a very good gap. Okay, there's still a very good gap between household median income and the price index. Why? Because HDB owners, if you look at the chart, you would know that since 2013, it has gone down, and then it did not really recover until 2019 when the government put in the enhanced housing grants, okay, to basically put more money into HDB owners' pockets. Because you put into buyers' pockets these extra grants, they will pay to sellers. Sellers suddenly can sell at non-negative sale prices, or at least at a higher profit, right? So that's why markets finally have caught up for HDB owners. And now is a very good time for you to, if you want to move on, to cash out. Okay. Reason being, now a lot of you are not sitting on negative sales. You will have more profits to buy into private. And that is also one reason. Okay, this is also one reason why last year a lot of private market prices have gone up, because HDB owners are also cashing out to move on to something else. Okay, so what I'm seeing in the next few years is that there's still going to be record numbers of HDB upgraders, and this is going to impact private home markets, because HDB upgraders they have aspirational needs. They want to buy into condos for the lifestyle. They want for status. They want to achieve one of the C's in their life. Perhaps they want a gated community, or they want a bigger space, right? So they are buying and upgrading into a condo for that reason, and a lot of them will still move into that category. And they are usually the MOP owners are younger, right? The younger ones would have more security in their jobs, usually good incomes, okay, stable incomes, and they know they'll be re-employed if they lose their job. So they are more eager to take this leap of faith. Okay, and this should push up the market still. There's real demand, I'm saying. Okay, so just take note of this. There's genuine demand in the market, and likely not to be cooled yet for the HDB market. I mentioned earlier also that the HDB market is not really being cooled by the recent cooling measures because well, government still wants it to ramp up a little bit. Okay, so I imply it from their actions. If they had wanted HDB prices to come down a little bit more, or to slow down a lot more, what they have done is to reduce the MSR, or even to reduce the loan to valuation by a higher amount than just 5%. Okay, so further cooling measures are still possible if market continues a strong uptrend. If in 2 to 3 quarters time we see that prices start to ramp up again, okay, another 3% growth in the quarter, 4% growth in the quarter, we will definitely see another cooling measure event. Okay, so this was a study I did. I'm not going to explain the whole chunk to you. I have done before in the previous talk, but I just want to condition you to three conditions. Okay, 3 conditions where cooling measures are applied. Number 1 is a drop in affordability. Okay, whenever there's a drop in affordability, it can happen. So this is the gain or drop in affordability. You can see that in the last quarter, it was 10% drop in affordability. Okay, and then when it was early on, when it was 18%, right? It was okay. The 18% one had a drop, had a cooling measure event occurred. The 8 one didn't have. 7% drop in affordability. Cooling measures happened. Okay. So second, it could be also that income to property price index ratio drops too rapidly. Okay. For example, from 53, it dropped to 43. A cooling measure event happens. If it doesn't recover and keeps dropping, right? Like 51 to 47, it keeps dropping, then there will be more cooling events, cooling measures. Third, when 52 or below, the income to PPI ratio is 52 or below. Note that we are currently very close to it. We are 53. Okay, barring I do not have the latest median income numbers for 2021. Okay, so we could tell ahead of time whether a cooling measure event is on a near horizon or a far horizon. Okay, so if our income to PPI ratio currently is about 60, 63, 65, very likely we are still far from a cooling measure event. Okay, so now we are really near, very near to the borderline case. So it really depends the next second, third quarter, how the market reacts. If it goes sideways, no cooling event, very likely. If you go, affordability goes down to 52, 51, 50, and so forth, definitely another one is coming on the horizon. If it goes up, starts to ease off, which I think is unlikely because of different reasons I'll cite later on to you. Then, well, if it goes up, then likely no cooling event because it has sufficiently cooled. Okay, what we also need to know is that there's very strong holding power among investors. This is a chart showing your household net worth in Singapore versus property price index of non-landed properties. Okay, you can see a very steep climb in the blue line. Okay, a very steep climb in the blue line, showing that household net worth is growing much, much faster. So there's low risk of prices correcting, because even if correction happens, right, people who are sitting on strong household net worth will not be selling. They will be like, okay, I'll wait until market recovers. I'll rent out first. It's okay, I will not sell. I'll wait and make a profit and I sell. You know, people have that mentality when they have money. When they have no money, no jobs, then it's a different thing altogether. Or there's over leverage. What will happen is then they will be dumping their properties. Okay, which is an event we don't want to see happen. That's why there's TDSR. Price indices rising across all residential segments. Okay, this is to show you the last high, where are we above the last high. So in the landed segment, the yellow color one, we are almost 10% above the last high. Okay, the last high was clocked in 2013. That was 8 years ago. 8 years ago, 10% above last high. Condos, on the other hand, are 13% above the last high. And HDBs are just 4%, slightly above the last high. So that's why I also say that HDB owners have a long way to go to gain more. Okay. However, just take note, of course, you can gain 5% in your HDB, but it may not, because the denominator is low, so it may not even be more than like a 2% growth in a private condo, because the denominator is much larger. Every 1% growth in condo or landed goes up a lot more. Okay. So well, demand by upgraders last year was likely fueling this private market growth, because a lot of them were selling, moving up, right? A lot of BTOs in the past 2 years, especially. So a lot of them are buying into private homes next. Now, which segment then in private market is there value to be found? Okay, this is what I have found out. For the OCR region, the yellow color one, OCR region refers to regions that are outside the core region. Okay, so places like Tampines, Pasir Ris, Yio Chu Kang, Punggol, or like Jurong. Okay, these are all the OCR regions. Okay, or your Bukit Panjang OCR regions. So it's gone up 16.5% on last high. RCR region, okay, RCR region refers to the brown line or the orange line, is 21% above the last high. And then your CCR region, your core central region, places like town area, basically your Marina, your Tanjong Pagar, Orchard Road, okay, Novena, so on. These are all below the last high, okay, 2% below the last high. Okay, it could be also due to the government's decentralization efforts over the years, right? Wanting more jobs, more to be decentralized, so that not to tax the MRT too much and the transportation systems too much. So that's why you see OCR, RCR regions performing much better. Okay, but where we see value in this 2022 is in the CCR region. So you can focus your efforts in looking at CCR properties, because or near CCR properties, even slightly out of CCR, like the Upper Bukit Timah Beauty World area, because these areas are likely to see a growth spurt with the return of foreigners in 2022. Okay, likely to happen unless something happens to stop them. Okay, there's also going to be a sector rotation by investors. Those who are overly into OCR, RCR market, who have made their money, might now be looking to cash out to look at what they can get in a better location. Okay, generally a better location is referred to as town area. The closer to town, the better. Okay, although may not be the best place to stay for some of us, right? But it's regarded as the better location. Okay, so just take note of that. CCR region is going to be a hotspot this year. Post-crisis, I want you to just take a look. Okay, these were the previous crises. Okay, from the dot-com bubble bust to the global financial crisis. Okay, markets in landed properties went up 16.6%, high peak to peak. Okay, peak to peak. Okay, and then from the GFC to our cooling measures, peak to peak, right? It went 52% higher. Okay, so this was the peak then, this was the peak here. Right now, where's the next peak? I don't know yet. Let's just draw hazard a guess. Okay, so the next peak is definitely higher. Why? Because we already passed the last high, right? So currently we're only 9.9% higher than last peak. So how much higher can we go? That's a question to ask. Okay, how much higher can we go? But chances are there will still be quite a lot of appreciation in the landed market even. Why? Because from my pulse on the ground, right, a lot of agents are in my team, and we talk about a lot of demand, supply. Are there sellers? Are there serious sellers even? In this market, a lot of people are holding on. Okay, people are by and large not urgent to sell. Most of them are comfortable. So, and if they want to sell, they want to buy something, and they will find that, oh, I need to have much more profit so I can buy something else. So prices are not soft at all. Okay, so with this in mind, when sellers are missing or not really serious, you can expect prices to go up. Okay, despite this window of time. This window of time is when people are not sure, right? Post cooling measures, people are not sure, hey, how is it going to go up or down or not? So this is a period of time where sellers are also thinking, is this my best time to faster sell before it maybe will come down? Maybe, I don't know, but maybe what if I already so much profit, maybe I should sell already. Okay, so if you're out there shopping, you should shop like mad these 2 months. Okay, you shop like mad really, because it's your window of opportunity. Government gave you this window so that prices take a breather. Sellers also come back to earth. Okay, from from space, come back to earth a bit, be more reasonable, and then come on, let's do a deal. Okay, so if you're a buyer, better go out there and start searching. Just a minute. Start searching right now and start to make your offers, because this is your opportunity. Okay, if you're out shopping with developers, this is also your opportunity. Don't any developers tuning in, I'm so sorry, but I'm just telling people what they can do. Okay, if you're in their shoes. Okay, so you should also squeeze a little bit. Try to. Okay, try to. If you're lucky, you get it. If you don't get it, right, very likelihood second, third quarter it will still go up. Yeah. Okay, so how much higher did non-landed private homes exit the past highs? Okay, so we can see also the same thing. Previously, we had this high, dot-com bubble bust, global financial crisis, and then after cooling measures, right? So 28% growth, 11% growth, and currently we are already past the 11 the last time. Now we are 13% growth. Okay, so where are we going? Question mark. I also don't know. Okay, I also don't know how high it can go. But looking at the increase in a lot of money supply, look at foreigners not even having entered our market yet so far, the bulk of them, okay, because it really paused, foreign buying really paused in the past 2 years, okay, and the market really went up so high. It's really local demand, genuine demand most of the times, okay, so it's very likely that it can go further higher. Now, isn't the government going to do more things than just putting an ABSD, and all these cooling measures? Why can't they just ramp up supply? Okay, I know some of you may be asking that, because that's also logically, you increase supply, then the prices won't escalate so fast, right? Well, yes and no. Government has a duty to also sell land at the market price, at the best price they can get, right? It's our raw material for our country. So they want to sell at the best possible price. They can't be like releasing a lot of land too fast, and then the prices become not the best price they can get for our coffers, okay, our treasury, right? So they would release, and they have increased in fact recently, but it's still at a low. You can see this chart, right? Unsold supply excluding ECs, unsold supply has gone down a lot. The blue color line, this has gone down a lot. And usually the replacement rate, it should be somewhere here already by now. Just that the latest data from Europe isn't out yet, but it should be here. Unsold supply is somewhere at a low of about 15,000. You can see the last time was so low. What happened to the market after that? The yellow line, the yellow line, it started to go up. When it was so low, it was at the bottom, it started to climb up. So currently we are, although the market has already climbed up, right? We are also so low. So it's very likely that here we'll see pressures going up, price pressures pushing it upwards because of lack of new launch supply. Okay, so let me erase everything here. And then we can see potential supply from en bloc GLS confirmed sites, not including the reserve sites. Reserve sites have to beat a certain price. You meet government's target price, then it will be confirmed. Otherwise, this is the supply currently, very low. If you see historically, this is a very low point. Okay, usually by now government should have released more land, but because you can release more land, but there is another issue. The other issue is that labor. There's not enough foreign labor that can come in to help you to construct. So construction labor is missing. Even if you release more land, what will happen is land may be cheaper a little bit for the developers and ultimately sometimes for the consumers. But you have labor inflation going on. That means cost of construction will go up tremendously. So add up, it will still be a very it still be inflationary in prices. So that's also the issue that well, between a rock and a hard place, what to do. Okay, so might as well just release land slowly still. And this is why I feel that even if they are releasing more land now, it will just give people the impression, okay, prices should be softening because so sentiments will drive behavior. So they will just slow down the buying. People will slow down the buying. But then right now they're not even doing that. Okay, they're not even doing that. That's why I see the pressures going up. The real pressures going up. Okay, buying pressures, demand pressures. Okay, next we take a look at low supply of completed private homes against record MOP upgraded volume. What I have mentioned to you as genuine demand in the market that is really driving the market. You can see the blue bars, these blue bars, okay, all these blue bars here refer to MOP volume every year. Okay, you can see since 2019, there's been record volume driving the market, and then this is still record volume considering that the past volume was super low. Okay, so 2021 was also very high volume. 2022 is also very high volume of upgraders, and then it starts to moderate only in 2023, 2024. Okay, now all these upgraders since 2019, 2020 were upgrading, moving to a private home. For most of them, of course, some of them would sell the Hdb, buy an Hdb, but it's very few of them would do so. Most of them will sell Hdb, and then they try to move up into a different asset class, okay, a private asset class. So what we are seeing here is this year, okay, this year 2022, there's still a lot of upgraders, and this should continue to fuel home prices. Okay, local domestic demand, real demand, not your speculative activity, not your investment demand even. Okay, although yes, some of them who made sufficient money from the BTOs, they sell it, they buy a home, they have excess cash, they may buy a second property under their wife's name, their husband's name. Okay, so what I'm saying here is you can expect high growth this year too, within 4 to 6% forecasted. The property market should still grow 4 to 6%. Only next year and the year after, then we can see moderated growth, slower, maybe 2 to 3% per annum. Okay, but it should still grow until well, probably at least 2025, 2026, which we don't know what's going to happen because this part depends on supply confirmation. At this point, we do not know yet whether the red line will continue climbing. Yeah, because as of now, there's a lot of backlog in construction, delays, delivery of even HDBs, they are delayed. Completion, even private homes are being delayed. So we are not too sure yet how much supply will come up then. Okay, so we will update this in the next half a year, and then you can join us then to see what's going on. Okay, there's still a shortfall in average completed supply to make it easier to see here. Okay, you can see 2022, there's a shortfall in supply. 2021, there was a shortfall. 2020, there was a shortfall too. And this was what was pushing the market up. Because when choices are not that many for completed homes, people have to fight for the same pool of homes, and that drives prices up too. Okay, and even in 2023, 2024, even if it meets the average 10-year supply, it's not a lot. It exceeds or merely just meets it exactly. So it's not going to make up enough for all the shortfall that we are seeing currently. And then in 2025, you can see a drastic shortfall effect. Now, this year is 2022. To build a home these days, you need 4 years, or some people will say 5 years even for the delays. Okay, so that means by 2025, it is very unlikely for you to see drastic supply coming in this year. So we will see a massive undersupply looming in 2025. Okay, so just let that sink in. 2025, so from now to effectively 2025, there is quite a clear path. Prices are unlikely to be pressured downwards by oversupply, okay, because there's so much demand and not enough. Okay, government is not likely to want to crash the market, right? They at most want to slow down the market. So unless there's something we can't foresee, otherwise it's pretty easy to predict what's going to happen. Okay, because real estate is a very slow moving market. We can have a lot of data points before you even move forward with our decision. Okay, let me pause for a while, have a drink. Okay, market segment price trends. Just take a look at the different markets quickly, all right? So outside core regions, non-landed properties, okay, when they went down during the COVID period, it went down 16%. Currently, since then, it has gone up by 15%. Sorry, 16% down, 15% up. At this point, the average OCR price is around 1450 per square foot. Okay, the average OCR price is around 1450 per square foot. We can see the rest of central region. Okay, sans the outlier event of Canning Hill Piers. Why? Because that's a RCR region property that is close to the CCR region, and that's why the price point is different. It's a Clarke Quay, right? So it's very, very popular, although the region itself is RCR. Okay, so the price point it has gone down at a point 17%. It went up by 13%. At current point is about 1,009 per square foot. Okay, averagely RCR region. For core central region, okay, it went down 18% during COVID, and then it went up since then by 15%, making it around 2005 to 2006 region per square foot, averagely. Okay, whether you are buying a new or resale property, averagely 25. For landed, okay, well, we went down quite a bit during COVID, and then it's quickly rebounded. Okay, the outside core area is currently going about 1,000 per square foot, averagely. Okay, and then you can see rest of central region landed, it went down 71%. To qualify this, I don't think it's very accurate because there's a lack of volume here. So this part we might not want to take it with a pinch of salt, because lack of volume does not accurately represent the market. So we must understand that. Okay, but after COVID recovery, it went up a lot. Okay, but well, the correction wasn't really accurate. So anyway, RCR landed is around 1,006 per square foot currently. And then your CCR landed properties, price point is up to here. Okay, this is not complete data at that point, and it's currently around 1,009 per square foot. Okay, and when it came down, it was about 63% off from the peak. Okay, currently about 1,009 per square foot. Not easy to find even in core central region, 1,009 per square foot landed property these days. A lot of sellers are asking higher than that. If you look at new versus resale from the COVID bottom till today, okay, for CCR, you can see that new properties, the orange line is new property, the blue line is the resale property. Okay, resale properties haven't gone up a lot. Resale properties have gone up by 5% for CCR. New properties have gone up by 20%. Okay, for CCR region. One of the issues could be size. Because CCR region, a lot of properties are very big, especially resale properties. So when very large properties are for sale, your quantum is naturally very high. So not a lot of people want to go into resale properties, very large, very old. Some people want, but some kind of afford because naturally it goes up too much in price every per 1% increase. Okay, so in pricing terms, there's about 32% premium between old and new. Okay, 32% premium. Okay, next. For RCR region, okay, and not considering the Canning Hill Pierce event, okay, we can see the bottom for new sale in RCR region went up by 18%, okay, from bottom, and then the resale market went up by 16%. Okay, there's a very small gap between new and resale for RCR. So if you are going into RCR region, you can look at new instead because, well, very new, very small gap. Okay, there's only 28% premium difference. Okay, and then for OCR region, from the bottom, COVID bottom to the top, for new sale, it went up 19%. For resale, bottom to the top went up 14%. Okay, and there's a price gap of 33% for new and resale in that region. Okay, just for your info. For ECs, on the other hand, resale performed very well. Okay, resale ECs are star performer during COVID. Okay, you can see the resale went up 20%, and new launch, these ECs went up only 11%. Okay, since then, and there's currently a very small gap, 17% gap between old and new. So you should definitely be looking at the new ones, okay, because the premium is not a lot of difference. Okay, unless location, you can get the location that you like. Now, this is what I see as the new price norms possible in this year. Average benchmark prices for OCR condos are likely to cross 1,007. I know once upon a time, 1,007 was even like the core central region prices, but nowadays, well, we have moved forward. So we have to learn to accept the new price points. If not, we might not be able to get something in the near future. So new OCR 1,007, new RCR condos are likely to cross 2,002. New CCR condos are likely to cross 3,002 PSF as a price norm. Okay, so please take note of this. Okay, so to also warn you of investment pitfalls, this is an area that has some demand from our team agents. Okay, because we really want to help our clients, our friends to make money, avoid loss. Well, this is our reason for existing, right? I like to say that we don't only want to make money and sell anything to clients because this is not our team culture. This is not the way we want to serve the community. So we also want you to make money and avoid all these pitfalls. So what are they? There's two primary pitfalls that you want to avoid. Number one, projects that have low growth potential. Okay, I know some of you like to buy into resale projects because of the location, because of size, and so on. But you have to be very careful. Some projects really have low growth potential. They have passed their prime, meaning they are in the stagnation or decline stage of their growth cycle. Okay, so in property investment, right, usually there are three stages for a leasehold property. Freehold property, generally, they resist decline quite a bit. So there are three stages. One, growth stage. Second, stagnation stage. Third, decline stage. Okay, the growth stage, G, the stagnation stage, and the decline stage. You would want to avoid buying here onwards. Okay, why? Very clear cut. You don't want you want your money to grow, right? Yeah, if you want your money to grow and it's not just a roof over your head, then you want to avoid buying properties that are stagnating or worse, declining. Okay, so our guys have been trained to help you to also identify this so that you do not jump into something, although it looks cheap, just be careful because cheap can get cheaper. That's the reason it's cheap in the first place, okay? So just be careful of that. So I just show some examples. I cover the project names. You can approach your agents to find out, okay, more about it. This using our in-house Huttons Analyzer app, okay? So this particular project, okay, I won't name it because I don't want to upset anyone here. I know some of you here might be the owners of this property, and then you take it personally. I feel very sad. Okay, so I would cover it up, but you can see that over this past 5 years, this project has only appreciated by 4.5%. 5 years, that's less than 1% per annum growth. Okay, this is an outlier, so we don't take the outlier. Okay, this outlier could be a lot of could be an error in data entry. It could also be somehow maybe a highly renovated unit that is unlike any other, but yeah, more likely a data entry error, okay? Or a very small unit, studio apartment that is and then there's just that one sale that month. That's why the average is so high. Okay, so we must know how to look beyond all these outliers. And then this is the district trend, 37%. For 5 years, the district itself has gone up by 37%, meaning about 6% per annum. Whereas this property owner who was sitting on it for the 5 years made less than 1%. He lost even to inflation. So it's like a double whammy. Okay, so be very careful when you buy into something. Cheap can get cheaper, or cheap can cost you a lot in the long run because it doesn't help you to grow your wealth. It doesn't help you to outpace inflation, which ideally an asset should. Okay, so please consult a NAVIS router if you're buying into anything. We have the access to Analyzer app on our device. Anytime we can check all these projects for you to make sure you're buying into a safer project. Okay, and it's not the only project. There's a lot. Okay, so another example, this is in District 16. Okay, District 16, this other project hidden. Okay, it's a little overlap, but District 16 has performed by 15.8% over the past 5 years. But this project only performed 4.3% over the past 5 years. Is lower than 1% again. So if it's not even matching the district performance, you can forget it. Yeah. If it's not matching the district performance, you can forget it. It means this property, without even looking at the property, I know there are some problems. Certain reasons why people are not buying. Maybe the tenant is too old. Maybe the layout is weird. Maybe somehow it's not popular among the area, among the residents in that area. Or maybe the maintenance is really poor. Could be a lot of reasons, okay? But just be very wary. Next one. This is in District 16 also, another project. It went up by only 5.6% in the past 5 years versus the district 25%. Okay, almost 5 times less than the district performance. So try to avoid. Next one, this is in where is this from? District 16 also, 7% versus the district performance of 16.94%. Okay. And another one in town area, District 2. Okay, where the district performance was 28%. Okay, this project went down by 1.85%, which is pretty sad lah. Okay, when everybody's appreciating in value, your property is going down in value. Yeah, so try to avoid. Although it's cheap, it may not be good. Now, some notes about identifying projects with low growth potential. Okay, usually it's due to aging tenure. Okay, generally leasehold projects between 20 to 30 years old. Generally, because some projects that have en bloc potential may not see the same low growth curve because speculators come in. Okay, second point, lack of demand in the neighborhood, low MOP upgraders in the area because the old neighborhood or there just isn't a lot of BTO estates, BTO upgraders. Then this can also affect your exit strategy. So when the owners want to sell, there are nobody willing to buy it from them at a higher price. Okay, it could also be too high a price quantum, meaning old projects that are too expensive because of size. And people just can't afford because of TDSR these days. Last time TDSR, now you have to abide by TDSR to buy, right? Okay, so delays in construction are fueling prices even in traditionally stagnant or declining properties. Okay, so it's artificial. In the past 2 years, it's quite artificial. Some properties that have been stagnating or declining suddenly see some life in them. Okay, but this may not carry on in the future. Once COVID is over, once construction resumes, people have choices in the properties they can buy. They can afford to wait. They may not buy up another level, another new price high for these old properties. They are already in the S or D segment, okay, stagnant or declining segment or a stage of their life. So you might want to avoid them. Okay? If they show recent signs of life recently, only during COVID, you might want to avoid. Okay, so properties that did not see much demand during normal market boom, as I mentioned, okay, but only experience it from this onwards, just be careful. Okay, next, I mentioned all this. This effect may only last as long as COVID measures are actively in place, likely to be temporary. Okay, so on the flip side, if you're an owner of such a property with low or no growth already, you might want to take advantage of this window of opportunity to cash out. Okay, why? Because then, when COVID is over, things resume pace, right? You may not have the chance to cash out at this high anymore. Okay, it's not forever going. If it's aging, your property is aging, you see that, hey, there's people who are starting to view, but no one really wants to offer. You might want to take on this window of opportunity to cash out. Okay, move your capital towards a property with better growth prospects. okay, that can appreciate still in the future. At least you can live in it and you can enjoy the wealth building effects. Okay, so these are the principles that we practice in property wealth planning. One of them being buy and hold forever strategy does not work for all properties, especially the leasehold ones. Okay, so do not just buy and close your eyes forever. This is not the ideal way. Okay, active recycling of capital is necessary if you want to continue to maximize returns. All right, not only make once and then let the money, the equity there stay the same or similar until it starts to decline. Okay, you want it to grow and grow and grow. Then you might have to adopt an active recycling of capital strategy. Okay, cheap can get cheaper. Be very wary of buying into properties that are in stagnation or decline stage. Okay. Next, Hdb flats with low growth potential. I know I've covered this with you all in probably one of the talks, but I just want to reinforce it's still in play. So you still have to take note if you own or your parents own a Hdb flat with low growth potential. Okay, of course, if they can help it and they are financially able to, then they do so. Okay, because of aging tenure or neighborhood oversupply newer flats, these HDBs can go down in price. These two, okay, because aging tenure, you can't reverse that, right? You can't reverse. There is also no guarantee of a top-out lease. Okay. So this was a study I did before. I just want to recap with you. If you've seen them, just take it as a refresher, right? So in the past, right, 2011 to 2021 study, we can see that the number of MOP projects, right, the number of MOP units in an estate helps property price index in the private estate. Okay, so HDB number of MOPs equals to people who want to upgrade, right? The more upgraders, the better for private property. Okay, the more upgraders in estate, usually the better for private property. Okay, except for some areas, for example, very rare one like Clementi, although that's very low, but very low number of MOP units, very high growth. Why? Because Clementi attracts not only Clementi, the neighborhood as well. Okay, from Upper Bukit Timah to Bukit Panjang and so on. Okay, so from Jurong side. So Clementi is also what we call a university town, a lot of tertiary institutions that attracts people to stay there. Okay, so the higher the MOP volume, the greater the property price growth for private properties. This is one good factor you can take a look at when investing in an estate. Okay, investing in a private property. Okay, this can help you to plan an exit strategy in the future. Make sure that someone will buy from me. Okay, look at this. Okay, however, on the other hand, it means that if you are a HDB owner in the same estate, you will face a lot of competition and your price may not go up. Okay, so just take note, it works a different way for different types of property owners. And these are the upcoming estates with the most MOP supply from this year to 2030. Okay, this is all the data we have at this point, and run along as we move over the years, we update these different numbers. Okay, so you can see here Clementi has about 1,700 units in the next 8 years. Okay, all these figures exclude your 1, 2, and 3 room flats. Why? Because generally 1, 2, and 3 room flats, when you sell it, the cash proceeds return, right, might not be sufficient to buy a private. So we are being conservative here to avoid adding in 1, 2, and 3 bedroom flats. Okay, so there's going to be a lot of MOP in Punggol Sengkang. If you're an owner of a Punggol Sengkang Hougang property, you might want to think twice about holding on too long and move on to a private asset in this neighborhood. Yishun Sembawang is also very high. Pasir Ris, Tampines is also very high. Okay, Tengah is also very high. Bukit Panjang is also very high. Okay, so if you need these slides afterwards, right, refer to your NAVIS agents, you'll get them, and then they can also advise you which is the better buy across the island. So I'm reaching the end, and I'll just share with you my summary of what we have covered, and furthermore, why I see there's more room for growth. Okay, so you can know these are the major points. From this cycle, we can see that the property market has already gone up 27%. Okay, every time there's a low, is a higher low, a higher low, a higher low, a higher low, a higher low. Okay, generally this happens because cost of living goes up, wages goes up, everything goes up. Okay, so that's why your higher low happens. Okay, in the past, every cycle is about 39% growth, 60% growth, 63% growth. This time round, we are 27% growth from the last low. Okay, there's a high chance it can go up further. And every time it comes down, it usually doesn't come down as much as it goes up by. Okay, usually it doesn't. You can see except for 42%, right? The 24% decline, 24% decline during this was during 2008 subprime crisis. The 12% decline during the cooling measures. Usually it doesn't go down as much. Moving forward, I don't expect market corrections to be so volatile too. Reason being, current version of government is like, to me, it's a current version 5 lah. Last time government is version 1, version 2, version 3, right? Now version 5 government, very smart. They know how to preempt the market. They know how to put in a lot of levers to prevent volatility in Singapore's market. So the next time it corrects, even COVID lah, did it correct by much? Nothing, not even much, okay? Or at all, right? Just a little bit, maybe for 1 or 2 months, and then that's it. It bounced back up. So moving forward, I see a lot of room for growth. It may not grow as fast as you like. If you like fast and trails, right? You want to invest in stock market or in crypto, okay? But not in property. Property, you don't get that kind of trail, but you get safety. You get low volatility, okay? And if you're lucky, if the economy does better and incomes as a whole of the island residents go up, you can bet that the government will release a little bit of the handbrake and let property prices escalate faster. Okay, so what you have is very steady management by the government of your investment, which I kind of like, because all the scholars at the top are really, really smart, right? To take care of our investments. By and large, most times. I know what you're thinking. Some of you are thinking like the Temasek Holdings and all these things. Okay, steadily decreasing unsold supply. Okay? This is a fact. Unsold supply has been dropping. The new one, when Q4 results are out, should be somewhere here. Okay, the new one should be somewhere here. So this bar is the unsold supply is steadily reducing, and there is really not much choices on the market. Meaning developers themselves do not want to sell so fast. Why? Because it costs a lot of effort to plan a project, to bid for a project, and then to develop the project, right? And right now, when they don't have many units left, guess what they will do? They will sell slowly. Generally, they try to put up prices. They push up prices because this is where they know that, hey, moving forward, if I want to bid for new land, it may cost more. Okay, so I want to profit from here as much as I can from my low cost inventory. Okay, I want to make as much as I can from this remaining inventory. And furthermore, it's not a lot of inventory, and most of them have ample time to sell out without incurring ABSD or QC. Okay, so developers may shout about discounts. Okay, some units they may throw out some discounts, but by and large, most of them do not want to discount much. Okay, because they are pretty confident on the market. Construction costs, inflation. Okay, if you follow the news, you'll see articles like that. Okay, you have to join the dots, you will realize that, hey, costs are going up. So even if developers want to sell lower, okay, they can't because the costs keep going up. So simply as that, it's not only land prices that are expensive, but upward price pressures on the supply side. Okay, due to supply side constraints of labor and material. Okay, so you can see there about 15-30% increase in construction wages. Okay, low supply of GLS. This was quite recent. Okay, this was 16th of December when there was a confirmed list being released by MND, right, for 2022's land supply. Although there was an increase of land supply, but generally it's not enough because there's a lot of developers with robust balance sheets, low inventory, like I mentioned earlier, and they have a lot of access to low cost of funds. Interest rates are still low. I know it's going up. Yeah, I know it's going up in Q2. But if you recall back in the past, right, when it went up after the subprime crisis, it did not go up a lot at once. Whenever it goes up 0.25%. Then the government will see how does the market react to it. Does it slow down too much? Does it slow down the economy? If it does, they may halt the rate hike for a while, or they may even drop back just to push the economy higher before they raise it again. And in the past, it took 10 years before it even reached 2%. 10 years, okay? And that was the global financial crisis, subprime crisis. This time around is more severe, okay? So what I'm saying is the low supply is not enough to satiate the developers' appetite. And a lot of them will still be bidding for these sites. Maybe not as aggressive as in the past, as they have to incur higher costs, but they will still be bidding as aggressive as they can to win the land and deploy funds. If not, that's their business. They have no land, they have no business. All right, next we have the vaccinated travel lanes. These are set to revive our tourism travel sector, right, and increase foreign investments coming in. Like it or not, this has to come true. Why? Because it affects too many livelihoods. So Singapore government has to push for it to happen. So it will happen, and this will bring in a lot more foreign funds. Okay. Now, why will foreigners come in and buy? I mentioned earlier to you, right? I will talk to you about this. Why do foreigners come in and buy when there's 30% ABSD? Okay, government really foresee that they will come back. Why? Because not only is Singapore a good currency hedge for most countries, okay, but because so far during the crisis, medical facilities have been performing well, medical workers, the standard of living, the way that government handle the crisis, by and large, is one of the best in the world, okay, by and large. Okay, so this is a study also on just on the numbers. Okay, foreign investors return on equity in the past 10 years. Okay, the ROE for foreigners after paying ABSD, right, 30% ABSD, it's 55% over 10 years. Why I got 55%? Well, please check with your NAVIS router. I have a training done with them to run through all the numbers, but I do not want to go into mechanics right now. And it is as high as 25% for foreigners from FTA countries, US, Switzerland, Norway, Liechtenstein, and Iceland, meaning they make a lot more money as an investor than other countries because they don't have to pay ABSD. Okay, these foreigners are likely to come in and buy something here when the quality assets is here, a strong currency is here, and then well, ease of management generally is here because our workforce is pretty prompt. Okay, usually pretty prompt. Okay, and currency, for example, I just explained to you, if an Aussie were to buy, okay, an Aussie were to buy Singapore property in the past 10 years, even if they paid 30% ABSD, the Sing dollar alone will have grown by 36% against the Aussie, okay, and their total gains will be 55%, okay, ROE plus 36%, total of about 90% growth in 10 years, okay, and then that's about 9% per annum. Okay, so if you look at why the reasons why people buy into Singapore, there are more than one. It's not just property investment, but currency strength. See, against the ringgit, 27%, against the Indon rupiah, 50%, against the Indian rupee, 33%. Okay, most times Singapore currency goes up against other countries because we are not a net export country. We don't have so much resources, raw materials we need to export, and we have to fight with other countries over whose cost of goods are cheaper, right? We don't have timber or sugar or palm oil to export. But other countries, a lot of them are exporting a lot of their raw materials to services and products. So generally, that is why we can keep our currency very strong and why it's in demand, okay, for your info. So that's why when the government increased ABSD, they are foreseeing a lot of money they'll be pouring into Singapore when the VTL lanes, when everything resumes. And that's why they're just helping Singaporeans, hey, we just put this out there, right, to block foreign funds from coming too fast and furious, and so that you can have a chance to jump in and make some money for yourself. If Singapore properties are going to go up in price, Singaporeans and residents, by and large, should be the ones enjoying the growth, right? Yeah, so this is the reason they have to do this. But still, let me say that a lot of foreigners will still come back. Because, like, for example, in Indonesia, in the past 10 years, even if the property the property they bought into did not have any returns, it stayed the same. They bought at $1 million, 10 years later it's $1 million. They would have made from the 50% of growth in the Sing dollar against their rupiah. Okay, so and this is, if you go into a longer history, more than 10 years ago, 15 years, 20 years, 30 years, you'll see a consistent trend of this happening. Okay, and there's no choice because the way the economy is structured. Okay, so Singapore's MTI, Ministry of Trade and Industry, has also forecasted a growth of around 3 to 5% in 2022. Okay, last year we had strong growth, about 7%. This year, around 3 to 5% growth is expected. So there should not be high unemployment rate. There should be growth and there should be lower unemployment rate. So the economy will by and large be strong. We can also see there's no oversupply issues, as I mentioned earlier. There's material labor shortages that are impacting completions. That's why there are shortfall of completions, a lot of completions. Further to that, the number of units that are launched in the past few years, they are not sufficient to cover the next few years. Okay, so coupled with record numbers of HDB MOP upgraders and return of foreigners, you can expect a lot of upside pressure. That's why I say the cooling measure that we just saw could be just part one. There could be a part two coming, okay, if the market does not correct enough. But there's so much upside pressure. How can the market correct? It's not easy, okay, unless you stop loans totally or you really restrict loans to a very low rate, okay. So high average occupancy rates, okay, at this point, 93% occupancy rates, they are less than 6%, 6% of unoccupied units. So vacancy rates are very low, okay. So landlords, by and large, have no urgency to dispose of properties because of the tight rental market, because of the high yields they're getting. Recent rental renewals, if you are a tenant, you will know rental renewals have gone up, right? Because landlords, there's a lot of demand to stay within the country, okay? And earlier I mentioned rate hikes may start from second quarter 2022, but don't let that scare you. Do not be anxious just because of, oh, rate hike. Okay, rate hike is very generic term, very general term. Okay, but each hike is usually 0.25%. It doesn't just jump 1%, 1% or 0.5% each time. Don't worry. At the same time, it can also go up. It can stay the same for a while, and it can also go down, depending on how the economy becomes. Okay, and take heart that if interest rates really go up a lot, usually it's because the economy is booming super well, and you should be making a lot of money or having very good bonuses. That's why the interest rates can go up, okay, because governments are confident that there are a lot of people lending, borrowing to expand their business and so on, that they can increase interest rates without hurting the economy. Okay, so you don't have to worry so much about this. This news, although it's always in the media, is sometimes overblown. Okay, you can see that from the point of 2008 subprime crisis. Okay, this is the 2% mark. Okay, from 2008 all the way up till somewhere in 2019, then it went up, okay, to 2%, crossed 2% even before it started to climb down. Okay, so there were ups and downs, ups and downs, and downs. It doesn't mean it will just shoot straight up. And even if your interest rate is double, it doesn't mean your mortgage installments double. Okay, your interest rate is double, your installments will go up probably by 20 to 30%. That's all. Okay, it's not a doubling of your mortgage installments. So relax. And also understand that global inflation targeting, okay, we need to know what the bigger powers of the world are doing, okay, because they have a global inflation target of 2% or higher. The US, for example, has an inflation targeting rate of higher than 2%. The European bodies have a target of 2% per annum, okay. If you bother to and you're interested, go and listen to all the G10 summits. Global developed economies generally target 2% inflation. Okay, too much inflation is no good. Too low inflation or stagflation is no good as well. So 2% is the magic figure. Okay, and why we need to know this? Because you have to know when the world government and our government also wants to have inflation happen, right? Means that your money is going to shrink. Your money will shrink because inflation shrinks your money, right? So it is a conscious attempt to shrink our money. So we really need to put our money somewhere, because every year you hold your money, it's likely to go down by 2% averagely. Okay, and that is why our CPF also pays us at least 2.5%, right? So that you can cover your inflation. So that at the end of the day, you get back your retirement funds. You won't complain, government, my money shrank. Your money has increased because we are paying you 2.5% plus the extras, the extra 1% and so on. Okay, so you have to invest. Okay, so this is my summary of what has happened, and it's not the end. It's slightly coming to the end already, but just give me a few more minutes. Okay, Singapore's properties are transiting into an early to mid-bull market stage. Early to mid-bull market. Okay, it's our view that it may take a breather, maybe for 1 to 2 or maybe 2 to 3 quarters, as buyers pause to accept the new rules and the new ABSD rates, and sellers stick to their guns, as most are not in a rush to sell. In view of higher replacement costs, ABSD, and also a recovering economy. In a recovering economy, people want to hold out for a better price. Okay, Singapore properties are likely to be in an early to mid-bull stage, early to mid-bull market stage, and remains attractive versus the major asset classes we have gone through. Okay, so when the VTL lanes open up, when more foreigners return, we should see even more demand. So you also should grab a piece of the pie, okay, if you can. Core Central region is poised to grow the most in 2022 and deserve your attention if you can afford to look into that area. Okay, so this is in closing the summary of what I think the market will world will be looking like in the next 1 year, but we'll update again the next half a year, okay? Now, finally, some of you might be also asking me, hey, how do I find the right properties? Sorry, how do I find the right properties? How do I use what you have said and, crystallize into something and find a low risk, high profit potential properties? Well, I know there's a lot to digest. It's not easy for you, for a layman to have to choose the right property because there are too many factors involved. There are hundreds of properties to look, even for new launches alone. So what I suggest you to do is to contact our NAVIS router for assistance because they operate according to our 7 steps framework. This framework is rigorous. It's not easy to scan through and to know what to look out for. Why? Because we want to help our investors, our friends to go into low risk and higher profit potential properties. Okay, there is no 100% no risk and 100% profit one. Okay, just to qualify, we are not God. Okay, so but what we can do is to watch our blind spots as far as possible because every investment carries risk. We want to lower your risk by looking around the neighborhood, the master plan, and all the different 7 steps to ensure that you are taken care of. Okay, so speak to our guys for that. Now, this framework is to help property investors on maximizing your returns, lower your risk, and lastly, also to optimize your tax expenses. Okay, because our guys are trained in many ways to structure plans for you so that you can buy and save on taxes. Save on taxes, not avoid taxes. Okay, to help you to maximize your leverage. Also, in case some of you require higher leverage, you need creative financial strategies in order to do that. Okay, so our framework lets them help you achieve this. Okay, so there are a lot of things that you may not know, you don't know. You don't know what you don't know. This is what hurts you the most. Okay, some people think it's as easy as got money, just go on the shop and buy it. No, if you don't plan properly, you'll lose a lot of money later on tax expenses, on legal fees, on loan redemption fees, and so forth. And you make mistakes. That this is the I don't know what I don't know portion that our people can do for you. Okay, watch your back. Okay, these are some of the strategies, and our guys are also tuned in to help you, advise you on this in different ways, stretching tenure, refinancing, to borrowers, part purchase, trust, and so forth. Okay, these methods may be layered onto each other to guide you on a path. Step 1, step 2, step 3, what should you do to secure more funding, to increase your returns, to prevent to save on future tax expenses, and so forth. Okay, so please speak to them. It is not as easy as walking in to buy something, even if you have the money. It should be bespoke advice, tailor-made towards what your needs are, and to help you to watch any potential blind spots in your investment. Okay, so they should be walking you through a series of process like that. First, a discussion, of course, and a discovery to find out what are preferences and all. And under solutions is where they craft strategies for you so that you can possibly buy when you think that you're not ready yet. For a lot of people, they don't do in-depth creative financing solutions and so on. So they do not know whether you can buy, or you may not even know how to calculate and find the strategies yourself. So let our people do that for you. Then next, to identify the right property for you is very important. Not just, we train our people because we believe in doing this right. We don't want them to just sell because the highest commission or because it suits them, but we want them to go through this so that they find the right property for you, so that you make money, you carry on working with them, and that's the long-lasting relationship. Okay, this is our reason for existing. Okay, so finally, execution is very simple once you have gone through these steps with them. So please speak to one of the routers from NAVIS to get help from them. All right. Okay, so I've reached the end of this talk, and I will just be open to any questions you have for a while. Okay, we have probably about 10 to 15 minutes. I'll be happy to take some questions from the ground if they have not already been answered by our panelists. We have a few panelists here, Justin Kong, Matthias, who are helping out with the questions. Okay, so I'll let you have a few minutes. If you want to ask any questions, kindly put it into the chat group right now, and we'll stay on for a while to answer these. Otherwise, if you have nothing to ask and you don't want to hear the answers, then you're free to go. Thank you so much for joining us this weekend, and I look forward to seeing you at the next consumer seminar. Okay. So wait on for a while for your questions, if any. Okay.